The stock for Brighthouse Financial Inc., BHF, is currently trading at approximately $57.07, reflecting a significant plus 24.91% move since the last close. This is a massive intraday spike, and it's the kind of move that screams, something big is happening in the life and annuity sector, which is typically known for being, let's just say, a little more sedate. But here's the unexpected wrinkle, the insight you didn't see coming just by looking at the headline percentage. This surge isn't about some amazing internal operational beat or a surprise dividend. It is almost entirely driven by market chatter and substantiated reports of acquisition talks. Specifically, reports point to a potential buyout offer from a consortium led by Aquarian Holdings, with a rumored price tag that sits notably higher than where the stock was trading just a few sessions ago. This isn't a story of organic growth being recognized, it's a story of a long undervalued asset suddenly being repriced based on a change in ownership, which is a fundamentally different investment calculus. The expectation for Brighthouse Financial, which has been the common market narrative, is one of a complex, lower multiple insurance player spun off from MetLife in 2017 that consistently trades at a discount to its book value. The general consensus has been, and still is for many retail online investment accounts and generalist funds, that this is a value trap. Cheap, but for a reason, namely the volatility inherent in its variable annuity business and the sheer complexity of managing its legacy risk books. The market sees a low P/E ratio, currently sitting around 5.8x versus an industry average closer to 13.4x, and shrugs, assuming the low price simply reflects the underlying risk of its massive liabilities. Current market momentum and institutional drivers. The reality, however, is being dramatically challenged by this M&A noise. The current spike, which saw the stock soar from its previous closing price, confirms that for a certain class of sophisticated buyer, specifically private equity and other dedicated insurance players, the expected value is significantly higher. The trading volume today is absolutely explosive, shattering its 3-month average, which tells you that institutional investors aren't just dipping a toe in, they're buying aggressively on the rumor, trying to capture the spread between the current price and the rumored acquisition price of potentially $65 to $70 per share. This is a classic merger arbitrage situation being played out in real time, which is drawing capital from across the financial sector, including funds managed by firms that also oversee platforms like Fidelity or even high-volume trading accounts on Interactive Brokers. The large institutional players, those who move markets, are looking past the complexity and focusing on the statutory balance sheet and the highly valuable, yet hard to value, in-force annuity and life insurance business. The consensus has always been fixated on the GAAP earnings volatility, particularly from its alternative investment portfolio, and the effectiveness of its complex hedging strategy for its variable annuities. Analysts often penalize the stock for earnings misses, such as the one seen in Q2, where the reported EPS of $3.43 missed the consensus estimate, leading to a temporary post-earnings dip. Yet today's action completely overrides that past disappointment, highlighting that in the insurance sector, especially for a de-risking annuity carrier, statutory capital and the embedded value of the in-force book of business are what truly matter to a strategic or financial acquirer, far more than quarterly GAAP noise. The market is now being forced to reprice the stock not based on its current operational narrative, but on its sum of the parts valuation as seen by a buyer who can streamline the operations, cut corporate overhead, and leverage the regulatory capital. This is the shift from expectation to reality. Brighthouse's core business and financial backbone. To understand why a major player would bid such a premium, we have to quickly look under the hood. Brighthouse Financial is fundamentally a provider of annuities and life insurance products in the United States. Its primary focus is on two segments: annuities, which includes variable, fixed, index-linked, and income annuities, and life, which offers various life policies. Since its separation from MetLife, the central strategy has been to manage and run off its legacy higher-risk liabilities, the runoff segment, while aggressively writing new, less capital-intensive business, particularly its flagship Shield-level annuities. Their business model is entirely dependent on effective asset liability management, ALM, and navigating interest rate environments. The recent period of rising interest rates has actually been a structural tailwind for the entire sector, including competitors, as higher rates allow insurers to earn more on the fixed income assets that back their liabilities. However, Brighthouse's unique challenge has always been its high-risk profile tied to market swings affecting its variable annuity book, a segment where product guarantees can be costly if the market moves against them. This is why the firm places so much emphasis on its detailed, complex hedging programs whose performance often dictates the quarterly earnings narrative that retail investors on platforms like Robinhood or even those using Schwab Intelligent Portfolios tend to focus on. Previous reports like their $750 million stock repurchase program announced in late 2023 show management was clearly acting to close the gap between the stock price and its book value. But clearly, an external party believes they can create more value faster. The institutional activity over the last quarter, though showing some net decrease in shares held by giants like Vanguard and BlackRock, also featured significant increases from others, including FMR LLC, Fidelity's parent company. This suggests a quiet underlying divergence in institutional opinion, with some exiting due to complexity and others accumulating, anticipating a value recognition event like the one playing out today. Future outlook, catalysts, and risks. The immediate future for Brighthouse Financial is now a high-stakes waiting game. The primary catalyst is the confirmation or denial of this acquisition talk. Should the deal be confirmed near the rumored range, the stock has a clear near-term price target that is significantly higher than today's price, offering a premium for those who bought today. This is the expectation being set by the market's current trajectory. The reality is that merger talks often fail. The complexity of Brighthouse's balance sheet, particularly the capital requirements associated with the assumption of its legacy variable annuity guarantees, is a significant hurdle that can derail even advanced discussions. Furthermore, the financial metrics of the deal must satisfy regulators and the acquiring consortium's financing partners. If the deal falls through, the stock will almost certainly retrace most of its gain, crashing back to the levels dictated by the value trap narrative, where it's judged primarily on its choppy GAAP earnings and the operational challenges of managing a massive legacy insurance book. On the flip side, even without a successful acquisition, the market is now forced to contend with a new, higher floor for the company's valuation. This public bidding war, or even the credible rumor of one, has essentially acted as a massive, unsolicited third-party validation of the company's intrinsic worth. This means even if the current deal collapses, it establishes a precedent for future strategic activity. For investors focused on long-term fundamentals, the company's stated goal of achieving specific statutory free cash flow targets and continuing to execute on its $750 million stock repurchase program remain important, providing a baseline for value creation separate from the acquisition excitement. The sector itself, life and health insurance, benefits from secular tailwinds like the aging U.S. population seeking retirement income solutions, driving demand for products like the annuities Brighthouse specializes in. Platforms dedicated to helping individuals manage their own financial security, whether through a Fidelity brokerage account, using SoFi Invest's tools, or even exploring intelligent portfolio options, sees this demand as a long-term anchor for the company's new business sales. The risk, of course, remains. the interest rate environment could reverse, punishing the long-duration fixed income portfolio, or the company could take a significant, unexpected charge on its hedging program or alternative investments. The current market action is a strong reminder that the biggest gains can often come from unforeseen corporate events rather than steady operational excellence, making the underlying fundamental value of the assets suddenly exposed. Comment below and tell me, do you think BHF gets acquired at $65 a share, or do the deal complexities and regulatory hurdles ultimately sink the offer? Your take on the regulatory aspect is especially interesting here. Synthesis, expectation versus immediate reality. The core insight here is that the expectation of Brighthouse Financial as a slow,